Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer, Equity Armor Investments. We're going to take a look at Nasdaq-100 activity and, of course, talk about what's happening in the volatility markets. Brian, it's great to have you back. Welcome to Trade Talks.
Thanks for having me.
All right. And of course, the conversation this week is focused around the Fed rate decision and the impact on volatility, because Brian, it really, the past couple of weeks have been the story of round tripping 2, 3, 4% in all of the major averages, particularly the Nasdaq-100. I mean, as a trader, it's got to be, your head's got to be spinning a bit here.
Oh, it's definitely spinning. And, we talked earlier in the year that I was worried that volatility was starting to uptick and not come down. And then obviously the Fed rate decision, doesn't make any things easier here. But what is interesting, actually, when you look at the VIX, when you look at VolQ, some of these volatility indexes, they actually spiked harder prior to the Fed decision meeting. And now going into that, they're a little bit lower. So to me, actually, that's maybe a good sign that some of the news is being digested about what the Fed had to say. However, having said that, if the Federal Reserve in the back half of the year is going to be taking liquidity out of the system, that's going to continue to bleed volatility into the stock market, because obviously with less money in the market, that's going to make things swing around. You just got to trade it very nimble. Like you said, heads are spinning, but if you're nimble and you trade the back and forth action, there's some opportunity.
Right. And Brian, you've also been talking about the fixed income market. You have some concerns there as well.
Well, yeah, certainly. When you look at the level of volatility that comes from the stock market, we always say there's a ripple effect, that area can bleed into other parts of the market. And it looks like the bond market, definitely the high yield area, is looking to roll over a little bit here. Now, if rates are moving higher and we have more volatility, to me, if I'm owning high yield fixed income, it's a dangerous area to be in, because I'm not collecting a lot of interest on it in terms of a coupon payment. And yet I am subject to bankruptcies and all the other volatility that happens in the stock market to bleed into there. So, when I look at some of the high yield, HYG, an example, ETF of it, it really looks like it's rolling over. I'd be very cautious owning that kind of thing.
And Brian, let's talk about earnings as well, because we hear a lot that stock prices really are predicated what we're seeing with earnings, and that's what helps to justify valuations. But it seems as if stocks have really been focused on inflation and Fed policy. We had Microsoft, we had Tesla, two big heavyweights in the Nasdaq-100 report, and now we have Apple coming up tonight. So what are your thoughts around these big tech earnings, or is there anything of interest that you see there?
Well, look, we own a couple of those names in the mutual funds that we manage, and I own the Nasdaq myself. But having said that, looking at those earnings, I actually thought Microsoft Tesla earnings were actually quite good. I think what's needed right now, when you look at the level of valuation in the Nasdaq right now, I think it just needs a quarter or two of catch up in order for some of those valuations to come down. If we're going to have a higher interest rate environment, less liquidity in the system, to me, all that means is valuations have to come down a little bit, not necessarily the stock prices crashing out. I think we've gotten a 10% or more correction now in the Nasdaq. Now I think if we get through this earnings, we get some earnings catch-up play. I still expect the earnings to be good. I expect Apple's earnings to be good. Another name we own and we manage. And so I think if that happens, maybe looking into the next quarter or the back half of this year, I think these stocks are going to be in great position. These big cap companies like Apple and Microsoft, they actually kind of like the market to shake out a little bit, because it makes it cheaper for them to A, buy back stock, or B, look at and own other companies in the world. So, this shakeout is not necessarily bad for them.
Yeah, it's really interesting, because typically we hear a lot about buybacks during the earnings calls and so forth. I have not heard much about buybacks at all for this particular quarter. And I wonder if that's because things were looking good going up until the last couple of weeks of Christmas, and we had some restrictions put back on. So that's really going to reflect in Q1. So it seems as if companies are also waiting for the shakeout to occur before they start initiating these big buyback programs.
Yeah, I mean, it's a great point. And what worries me a little bit is some of the CIOs of the world or whatever get a little skittish when they see all this volatility. This is the time for them to actually start to own it. Now, I think one reason why maybe we don't see it in the earnings call is, higher interest rates make it more difficult to borrow. So if you wanted to borrow and buy back stock or do some sort of trade like that, it becomes a little bit more difficult. And so, sometimes when the rates are moving higher, you may see a little bit of a pullback. And that's probably causing some of the volatility, because there's not the liquidity on the buy side. The liquidity that I talked about is going to leave the system the back half of this year if the Fed starts actually cutting the balance sheet. So that's something to be aware of. That's why I think VIX, VolQ, you're going to see elevated levels, probably higher than normal levels than you typically see with them. But again, we've had a pretty big sell-off here already. We get some good earnings reports. Maybe it just takes another quarter for shakeouts to happen.
So then I wonder if that will be a catalyst, well, actually lack of a catalyst going forward to buy back stock, because as interest rates go higher, I mean, you saw the amount of buybacks that we had. We know what buybacks do. for earnings and how it can kind of juice earnings a bit there. With borrowing money getting more expensive, we might not hear about buybacks as frequently as we have over the past 3 to 5 years.
Yeah, I mean, I think that's a real possibility, and that's something that, again, is going to be concerning. That's another part of the market where we had extreme level of liquidity in the system. Not only did we have the Federal Reserve rate put on the market, the protection of them dumping money into the system, when they pull money out, that actually bleeds in other areas. And now, stock buybacks may not be as frequent. That's going to lead to more volatility. Again, that just means you got to put your trader hat on, trade around these markets as we get big moves, as we've done the last few days. When we see the big moves, don't be afraid to take some off the table and wait for a better moment to get back in again.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.